Good afternoon. Welcome to the Lawron Ballard Show. This is episode 3 of the preseason. So the show technically does not officially launch until next week, Wednesday, but I'm getting the reps in, getting you guys familiar with and accustomed to us being here every single Wednesday, sharing the latest with you in regards to news, tax strategy, life, and more. So I'm so excited for you to be here with us once again. So let's jump right in. News this week. There's a bunch of stuff going on at the IRS with refunds. Funny enough, I actually had a client this week who has been waiting for a tax refund since March, and we are still in a holding pattern. But apparently, my client is not the only one who's having this issue, because there has been quite a bit of long tax refund delays through as a result of the 2025 tax season. So if you are waiting for a tax refund, I highly encourage you to reach out to your tax professional and see if they can do some additional due diligence to get you some more information on that. Hold tight, be patient, because there's supposed to be some changes coming on the horizon. Apparently, there is a hiring blitz at the IRS, so hopefully that will help to alleviate some of the stress. Second in news, if you have received an IRS notice, CP53E, I would highly recommend you take a look and watch for that, because if you've had an issue with your tax refund, there may have been an issue with your direct deposit information. And so notice CP53E would let you know whether or not there was an issue with your direct deposit. From the date of receiving this notice, please keep this in mind. You have 30 days to log on to your online account and resolve the issue. So do make sure you are proactively working to resolve that. And funny enough, I want to say hello to my TikTok family here. Thank you so much for joining the live. But for you who are here on social media, I want to let you know you got to be careful what tax advice you are taking from the internet. Why? Because the IRS has just let us know that there is an uptick in audits as a result of information people are getting from social media. And so while social media is a great source to introduce you to different scenarios, it is not social media is not your CPA. Social media is not your tax preparer. So I highly recommend clients. I have had clients come to me saying, hey, I heard about this on social media. Is this applicable? That is the right thing to do. We do not just take the information online and apply it to our circumstance. We've got to make sure that it makes sense. So if you're taking advice, if you're following content creators online who focus on tax strategy, make sure you are properly vetting that according to your situation. So now let's jump into our case studies for today. I've got 2 case studies that I want to walk you through. And remember, tax planning is more than just saving money. It is ultimately the reallocation of resources. It is moving money that could have been paid out to the government, and you are now able to use those funds to further your objectives, whether that is build your business, build a legacy for your family. Tax planning should be a part of that. And so excited to share these case studies and talk about what exactly is possible when you work with somebody strategically in regards to tax planning. So the first case study is a construction contractor. This person made $864,000 in the tax year. Their business was doing $4.5 million in revenue, and they were originally anticipated owing $332,000 in taxes. $330,000 in taxes. they were able to cut their tax bill by over 75%. Now, this is the really fun thing about tax planning. A lot of times people feel like it's overwhelming, that you have to have some high level of sophistication to understand it or implement it. Tax planning done well usually only requires you to take 3 to 5 actions to have a significant impact in regards to your tax liability. So for this client, they did the following. It is 5 strategies that saved them over $269,000 in taxes. Only 5 strategies. Only 5 strategies. The first strategy was an accountable plan. An accountable plan, I believe we discussed this in episode 2, an accountable plan is essentially a reimbursement plan that you create between yourself and your business to be able to take those deductions. Number 2 is the Augusta rule, or as I like to call it, the master's tax loophole. The master's loophole. And so this is for those of you who own your primary residence. You are able to take a deduction from on your tax return by renting your primary residence to your business. This is a nice one. And I want to just touch on this really quickly, a donor advised fund. So there's a lot of stuff, there's a lot of information that's going on and a lot of buzz about this in the media about whether or not you are able to make designations or you are able to identify who you want to give the money to once you put it in a donor advised fund. But most of the time you are able to have some type of input. However, you've got to make sure that you are paying attention to who you have as the custodian of your donor advised fund. But for those of you who don't know, a donor advised fund is when you make a donation. So let's use Bank of America, for example. You make a donation to Bank of America's charity. And in exchange for that, they will take your money, they'll put it in a fund for you to then issue contributions at a later time. The nice thing about a donor advised fund is that if you take it in the current year, you get the deduction for all of those years at once instead of having to spread it out over 3 to 5 years. I actually use a donor advised fund for a client, and a lot of times people feel like I have to be at a certain income level. I used this last year with a client who was looking for a way to lower their tax bill, but with the change in the tax law, it was actually more advantageous for them to contribute to a donor advised fund in 2025 instead of taking those donations year over year going forward. It saved them about 10 grand in cash tax. So awesome opportunity. Now, the next thing that this client did in order to cut their tax bill by 75%, they hired their kids. I'm sure you've heard about this on the internet about hiring your children in your business. There are a couple stipulations for that to make sense. Number 1, they've got to be at the age where the work that you are saying they're doing is appropriate. So if you have a 6, 7, 8-year-old, they can work in your business, but they should be making a very low wage and doing things that are age appropriate. However, if you have a 16, 17-year-old, then there is opportunity for them to work pretty much the full gamut of your business, depending on what you do. So that is another way for you to get a tax benefit by hiring your children. And the nice thing is that they do not have to, depending on the way your business is structured, they may not have to pay payroll taxes. So when you pay your kids, if you are structured properly, it is a 0 tax payment that you pay on their behalf. Now, the last thing that this client did was they maximized their retirement contribution. So there's a couple ways that this can be done, but just know if you're a self-employed, you should seriously be looking at creating some type of retirement package in order for you to lower your tax bill, especially if you are making high 6 and 7 figures in income. That's case study number 1. And so again, their tax liability before tax planning was $332,000. After tax planning, they got down to $62,000. That is somebody's salary that they saved in taxes. So that is the beauty of tax planning. Let's go to the second case study. This is a medical practice owner. They make $1.1 million in their business, and they only use 2 strategies. Remember, I said that there is only, you can get a lot done with 3 to 5 strategies. 3 to 5 well-selected strategies can completely wipe out your tax bill. So this client saved over 60%. They were originally expected to pay $307,000. They got their tax bill with just 2 moves down to $122,000. So the first move was an accountable plan. We discussed that previously with the contractor. The other one was equipment leasing. This was essentially setting up another business where the primary focus of that business was to rent heavy machinery to construction, etc. And so the losses that were generated in that business were able to offset the income from the medical practice, and that resulted in $184,000 in tax savings. So now let's move to our topic of the day. I recently got a note from someone who had a question about qualified opportunity zones. And I figured there's no better time than the present to discuss what does this mean and who should be looking to invest in qualified opportunity zones. So if you are privy to pop culture, you will remember several years ago, a entertainer by the name of Nipsey Hussle, who had invested significantly in his community in Compton, California. Now, what was going on with Nipsey? He was utilizing opportunity zones to take advantage of the tax code. So what happens with an opportunity zone? With an opportunity zone, this is the deal. You are able to defer capital gains. So when we talk about capital gains, we're talking about when you sell stock, when you sell business, when you sell real estate, anything that appreciates in value, you are paying something called capital gains tax. Now, with qualified opportunity zones, you are able to defer or pay later the capital gains tax. Depending on when you invested, you were able to get something called a step up in basis. We're not going to get all technical. All that means is that the IRS gives you a credit and basically says if you hold your property in a qualified opportunity zone for 5 years, I'm going to increase how much, according to the IRS, how much you paid for your property. If you hold it for 7, I'm going to increase it by 15%. So if you hold it for 5, it increases how much you paid for it on paper by 10%. If you hold it for 7, it increases it by 15%. This is where it gets really fun though. If you hold an investment within a qualified opportunity zone for 10 years or longer, any capital gains that you earn on the sale of that asset is completely tax-free. Amazing. Amazing. That is the value of a qualified opportunity zone and investing in that way. So now when we think about what Nipsey Hussle was doing, yes, it was very nice that he was doing these things, but ultimately he had investments and other things. And so he was taking advantage of what was put into the tax code to benefit the community that he grew up in. That is a major opportunity. So, but this is the sad part. Let me tell you the sad part. The sad part is, as of December 31st, 2026, they were scheduled to do away with qualified opportunity zones. And so this major inflow of cash into communities that need it and want it, as well as the tax write-offs for those who have it was going to be done away with. Well, love them or hate them, July 4th of 2025, the One Big Beautiful Bill was passed, and it made qualified opportunity zones permanent. So it has similar terms. You hold for 5 years, you get an increase in your basis. You hold for 7, you get another increase in your basis. You hold for 10, then any income that you generate from that investment is now excluded from taxable income. The caveat for, and we'll call this the QOZ 2.0, is that you have to sell the property within 30 years. So you can't have it for 10 and then hold on to it forever. You've got to sell it between 10 and 30 years in order for you to take advantage of that, because they do want to get money back into the economy. But I assume that if you did that, you could probably, well, you're not paying tax, but you could probably reinvest it again if you wanted to and continue the cycle. So with the overlap of the laws, we got the QOZ number 1 that's set to expire at December this year, and QOZ number 2 that's set to that is a renewing of the QOZ laws. What should we be doing? If you are a trader, if you have real estate, if you have stock options from your job and you're looking to sell those, and you want to explore whether or not a qualified opportunity zone would make sense for you, this is what I recommend. If you are not pressed for time, wait. I would highly recommend that you wait until Q3, late Q3, Q4 in order to take advantage of this. Why? Because you are going to miss out with on some of the benefits in terms of lowering your tax bill. The caveat, though, is that if you do not expect to pay a lot in taxes this year, then a QOZ may make sense, regardless of regardless of whether it's the old law or the new law. So again, make sure you work with your tax professional to understand the best scenario for you. But that is the nice thing about qualified opportunity zones. You get a deferral, you pay later the capital gains tax on what you originally put in to fund the opportunity, and then anything on the back end that you earn from this new investment is completely excluded from tax, from being able to be taxed if you hold it for 10 years, more than 10 years, or less than 30. So I hope that is helpful. If you've never heard of a qualified opportunity zone and you have something that may make sense for you to explore it, make sure you talk to a tax professional who can help you. I'd also be more than willing to answer any questions in regards to that if you have them. So please, if you're on LinkedIn or YouTube, you can send me, you can leave a comment. If you are here on TikTok, you can put it in the thread and I will make sure to answer your questions. Now, it's time to get to our questions of the day. Our questions of the day. So the first question of the day: should you be taking a standard deduction or an itemized deduction this year? Excellent question. The answer is, and it's the answer that everybody hates, it depends. If you live in a high tax state like California or New York, you own real estate, you give significantly to charitable organizations, it may make sense to itemize. However, the standard deduction is going up every single year, and less people will likely need or want to itemize. So, next question. Are you confusing a big refund with good tax planning? So, this is really dependent on you. Some people, I know a lot of people are like, well, I don't want to give the IRS a tax-free loan. If that's the camp that you're in, then no, that's not a sign of good tax planning. Good tax planning would have been that you paid exactly what you were expected to pay by the time your tax bill comes due. For others, they may have started tax planning in the middle of the year and they kept their withholdings or they kept their estimated payments the same. Therefore, for them, this is a good thing. So again, the answer that nobody likes to hear, it depends. But what I will say is that my clients are getting refunds. My clients are also seeing significantly lower tax bills. Both of them are work depending on the scenario. Next question. How are you managing your investments to mitigate capital gains? So I think the biggest thing to do in order to mitigate capital gains is to do something called tax loss harvesting. So with tax loss harvesting, what you are doing is you are selling assets from your portfolio that are not doing well and using those losses to decrease the amount of gain that you show on your portfolio. You do need to be careful and mindful of something called a wash sale, which is basically when you sell assets that are not performing well and then you buy them back within a 30-day period. And so you cannot do that. Whatever you were trying to do by doing that, you lose the advantage of because it's not allowed. But again, work with a tax professional. Okay, last question. Is your current tax approach proactive or reactive? So this is a question for you, my dear viewer. Is your current tax approach proactive or reactive? If the only time that you talk to your tax preparer or accountant or CPA, whoever you have filing your taxes, if the only time you talk to them is once a year, then I am afraid to tell you that you are reactive. We got to get into the habit of looking at these things consistently and on a schedule. Let me tell you a story. So when I used to work in public accounting, I worked at one of the large accounting firms in the country. One of the things that we would do with our large multinational clients is that you would be on that engagement all year long. So in addition to preparing the tax return, we were talking about understanding what is the tax impact to the financials throughout the year. We were looking for opportunities to lower their tax bill. We were partnering with their financial teams to assess and look at different strategies. So all year long, multinational companies are managing their tax bill. For you, it should be the same thing. Maybe you don't need to have a team working with you all year long, but it would be helpful if you had a team that talks with you at least twice a year, because then you can get ahead of these things. So if you are only talking to your accountant to file your return, you are not tax planning. You are just engaged for tax preparation. So that is it for today's show. I do want to just make a note of a couple things. If you are currently in the market or looking to work with somebody who understands tax strategy, tax planning, please feel free to leave a comment below. You can also send an email to connect@Hilltown Advisors. We'd love to have a chat with you and see how Hilltown Advisors can support you. And this show is brought to you by Hilltown Advisors. It is always a pleasure to be here with you, and we look forward to connecting with you next week. If you have any questions, if you have anything that you want to be discussed on the show, please do leave a comment on TikTok, or when you see the content on LinkedIn or YouTube, you can also put a comment there. I look at all of them because I want to make sure that this show is serving you well. So until next time, God bless you.